I am fresh back from my surfing trip in Morocco and I took one silver trade that paid for the entire trip. And in this video, I'm going to break down exactly the steps that I took and how you can follow the same strategy too. So as promised guys, here is the full breakdown of that silver trade that paid for my entire trip. Now on your screens, you will see the spot silver market. Now I don't just trade silver, I also trade the price of gold. I trade about 12 other FX pairs as well, a mixture of minors and majors, and also some of the main indices, namely the Dow Jones, NASDAQ and the DAX. Now this type of strategy does work on all of the above. And the reason I like this strategy mainly is because, especially when I'm working away or I'm working in other businesses, this allows me to spend as little time as possible at the charts. Now, if time is a major consideration of yours and you do not want to sit there on a 5 minute, on the 1 minute, even on the 15-minute chart can be quite painful, then this strategy might be for you. Now, we need to understand a few different concepts about this strategy, which I'm going to dig into in detail straight away. So in order to trade this strategy correctly, we're going to need to understand a few concepts. The first one is the fact that the markets move in a fractal nature. So what happens on one time will also happen on a smaller time frame multiple times. Now I, especially when I'm trading this strategy, always like to get my bias, i.e. what direction I think the market will travel in, from a longer time frame. Now this could be the monthly, could be the weekly. In this example, it is the daily, and it could be as low as the 4-hourly. Depends on how much time you actually want to spend on your charts. But I like to actually trade this strategy particularly between the daily to get my bias, and then I execute on the hourly. Now you'd always want to drop 2 time frames down from the longer time frame in order to execute this strategy. So it's very important that you understand what these time frames are. So if I was to look at the bias on the monthly, I would want to execute on the daily chart. If I was to take the bias on the weekly, I would want to execute on the 4-hour chart. If I took the bias on the daily, like I will in this example, then I would want to execute on the 1-hour chart. And if I want to take a bias from the 4-hour, I would then execute on the 15-minute chart. So that is the first thing you need to do. You need to understand and decide which time frames you are going to trade this strategy on, and then lock in on that strategy. Now you will notice from the chart on your screen that this is quite a blank chart compared to what most people would teach or most people would use on a daily basis on the charts. Now I like to just trade pure price action. Yes, indicators are good. Some of them are better than others. The likes of MACD, RSI, they can give indications. But the problem is they are all lagging indicators. So they tell you what has happened. Now I like price action because it makes the chart a lot clearer to see, and you can see exactly where the movement is coming within prices. Now on this strategy, we are going to need to understand 2 key types of candle that we are going to be looking for. And these are the hammer candle and the shooting star candle. Now you may have heard of these candles before, but I will break down in detail exactly what it is that I'm looking for on these candles. So in order to execute this strategy correctly, we do need to understand the concept of a hammer candle and a shooting star candle. So a shooting star candle is a bearish reversal candle that forms after prices have been moving higher. Now typically it's got a small body near the bottom of the candle and a long upper wick, and maybe no lower wick or just a little lower wick. And what this shows is that buyers pushed the price higher, but then sellers stepped in aggressively and rejected it, forcing it to close back down lower. Now, this shows that it's a clear sign of rejection of higher prices and a potential, and I mean potential, shift to the downside. Now, a hammer candle is just the opposite. So a hammer candle is a bullish reversal candle that forms after price has been moving down. It has a small body near the top of the candle and a long lower wick and a little or no upper wick. Now what this shows is that sellers pushed the price lower, but then buyers stepped in strongly and then drove it back up before the close. So it's basically a sign of rejection of lower prices and a potential move back to the upside. So now we know the definitions, let's look on the charts to see exactly what they look like in real life. So on the chart in front of you at the moment, you can see a shooting star candle labeled as a yellow candle, And in this example, I've even put a nice S above it just to show it very clearly. So as we said from the definition, a shooting star candle is a candle that after a price move up, which shows this clearly on the daily chart, prices have been moving up in general. The price has then opened at this level from the previous day, and at some point throughout this day, prices have started to creep higher. However, then over the course of the day's trading, these prices have been rejected, and we then closed at the lower end of the candle down here. So this has a long upper wick and then closed down here with a small body to the candle and a very short lower wick. So this is what a shooting star candle looks like in real life, and it's showing a rejection of higher prices. Now in this example, as we can see, the next day we didn't actually get reversal, but this is why I said it just indicates a potential reversal. There are other elements to this strategy that we do need to consider. Now let's see if we can find the hammer candle. So down here we have a hammer candle, actually one of the last candles that we've been looking at. This is marked out on my chart with an H here. I do actually have an indicator that I give to my clients that allows them to also then put this on to their charts and allows them to actually see very clearly then where the hammers and the shooting stars are. So if you're interested in that, then drop a comment below and one of the team can get in touch. However, this hammer candle shows that after a downwards price movement, sellers tried to push the price lower over the course of the day. However, then those prices were rejected, and then we closed back up here, which was actually higher than where we opened. So this candle has a long lower wick and a small body towards the top of the candle with a shorter upper wick. So this is what a hammer candle would look like in real life. Now, one really important point, and why do I only take hammers and shooting stars seriously on a higher time frame, like a 4-hour, daily, or even just a weekly, and not on something like the 5-minute chart? Now, it comes down to significance. So on a higher time frame, each candle represents a large amount of time volume, and participation in the market. And you've got institutions involved, real money flowing, and genuine decisions being made. So when you see a hammer or a shooting star there, it actually means something. It shows a real rejection of price and the potential shift in control between buyers and sellers. But on the lower time frame, like the 5-minute, you get a lot of noise, small moves, random volatility, algorithmic spikes, and these can easily create candles that look like hammers and shooting stars, but they don't actually carry any real weight behind them. So the same pattern exists, but it means completely different things. And that's why I always build my bias from the higher time frames first, where the signal is stronger. And then I drop down to the lower time frames purely for execution. So I'm not trading noise. Now, one really important point to make is, why do I only take these hammers and shooting stars seriously on higher time frames like the 4-hour, the daily, and maybe the weekly, and not something like the 5-minute or the 15? And what it comes down to is actually significance. So on a higher time frame, each candle represents a large amount of time, volume, and participation in the market. So you've got institutions involved, real money flowing, and genuine decisions being made. So when you see a hammer or a shooting star there, it actually means something. It shows a real rejection of price and a potential shift in control between buyers and sellers. But on a lower time frame, like the 5-minute, you get a lot of noise, small moves, random volatility, algorithmic spikes, and these can easily create candles that look like hammers and shooting stars, but they don't carry any real weight behind them. So the same pattern exists, but with a completely different meaning. And that's why I always build my bias from the higher time frame, where the signal is stronger, and then I drop down to the lower time frames purely for execution. So I'm not trading noise, I'm trading intention. Now, something else that we need to understand in order to execute this strategy correctly is market structure. We need to understand the basics, because this is what tells you the direction of the market in general. So in the trending market, price moves in patterns. Now, if the market is trending upwards, it will create higher highs and higher lows. This means that the market is pushing up and then pulling back. Each time it pulls back, it holds at a higher level and then pushes higher again. That is a bullish structure because buyers are in control. Now, the opposite is true for a downward trend. the market will create lower highs and lower lows. So price pushes down, pulls back a bit, but fails to get as high as before, and then it drops again. And that tells you that the seller's in control. And we need to understand these key levels where the higher highs and higher lows and the lower highs and the lower lows are in order to pick out a target for price. And this will make more sense when we look at the charts in depth now. Now, if I move over to the charts for the daily on silver here, we can see that we have been trending upwards quite aggressively for quite a bit of time now. Now, I've got a little indicator that I can actually put onto here, which would then show that market structure in real time. Now, on the chart in front of you, we can see on the silver market, we have been clearly trending up for quite a while here. And now we've actually started to make a little bit of a move downwards, changing into a bit of a downtrend. So when a market trends up, as I said before, it creates higher highs and higher lows. So if we use this pathway indicator here, we can see that the market has been trending up. We got to this point. We have just then pulled back, but it has failed to basically break this bottom level here. And it has then put in this higher low here. We have then continued up quite aggressively, and we've got up to this point. We've got some micro moves in the middle there as well. But I just want to give you a clear indication of direction. So that we've then broken this structure to the upside and we've created another high up there. We then pull back a little bit and then we've then continued to the upside up here as well, where we then put in a new high. Once we've done that, the market has actually started to shift lower. We've now started to break this low down here. We didn't quite close below it. We created what's called a change of character, which I'll deal with in later lessons. However, we are now putting in lows and then we're putting in a lower high. And then eventually I'm expecting us to come down here and maybe target these areas at a lower low. And you will see that the market will move in these waves. And then on lower time frames, what happens is this price movement creates micro waves within the major macro wave. So the only reason for this strategy that we need to understand these waves is to find these higher highs and higher lows. So now that we've explained the basics of the concept, let's go back to the chart and actually look at the trade that I took. So I looked at the daily candle, and I tend to look at this, especially when I'm away, at the close of the day. So we know all of that price movement has happened and the price is now closed. Now in the UK, that's around 10 p.m. in the evening, typically, but you've also got to consider the time changes as well. However, we had this candle here. Now it's not a perfect shooting star, but it has represented that the price has tried to push higher and then it rejected, and we ended up with a very small body indeed down here and a very small lower wick as well. Now what I want to do in this strategy, I want to mark the high of this candle and the low of this candle. So what I'll do here is if I just jump in and grab a horizontal ray from there, and we can mark up the high there and we can mark up the low down here. Once I've done that, I need to see, based on market structure, what the next low point is that the market may try to make its way to. And as you can see here, we've had a push down in the market here. This hammer candle was created, which has tried to push the market higher. And then I'm hoping that the market will then turn around and continue at this point to seek lower prices. Now, like I said, with all trading, this is a probability game, so this may or may not happen, but this is where risk to reward comes in, and I'll talk about that much later. So we mark up the high of the candle and the low of the candle, and then I mark up the lower swing point here as well. And the reverse would be said if we were looking at a hammer candle. So this would be the daily low. Let's just put some settings on there and some text so that we can see exactly what it is that we are targeting. So I'm hoping that the market is going up here. It's showing some signs of reversal, and we're going to continue down to the bottom of this candle here. So I'm hoping that the market is going to show signs of reversal by moving up here and then continuing lower down to this daily low level that's marked up on the chart. So then the next step of this strategy is we need to drop down to the 1 hour chart. And for the next bit, I also need to explain a concept called the fair value gap. Now you will see on your screen at the moment that there are these green areas and these red areas. Now let's start off with just explaining exactly what a fair value gap is. So a fair value gap is a price imbalance in the market caused by a strong, aggressive movement in one direction, either up or down. Now, it happens when price moves so quickly that it leaves a gap between the candles, meaning not all of the buy and sell orders were actually matched properly. Now, the simplest way to spot this is using three candles. So if the middle candle is strong and impulsive, you'll often see that the wick of the first candle and the wick of the third candle do not overlap. That space in between is the fair value gap. And what it actually represents is an inefficient pricing. The market moved too fast and it left unfilled orders behind. Now, because of that, price will often, not always, but often come back to that gap later to rebalance before continuing in the original direction. So as traders, we use fair value gaps as areas of interest. We're looking for a price to return into that zone and then show confirmation so we can then enter in line with the overall trend. Think of it like a market leaving unfinished business behind and then it's coming back to clean it up before the next move. And this is what these gaps in the market represent. This is unfinished business and prices and orders that have been left unfilled. So once I've actually got down onto the hourly, you can see that the marks that are placed on the top of the candle and the bottom of the daily candle are already marked up. So let's just tidy this chart up a little bit. So this there would mark the bottom of the candle, as you can see. Well, this is actually at 8 o'clock at night there, but as you move along one, this was because in this scenario we were dealing with the daylight savings time shift, and this was the top of this daily candle. So let's just put this in place here. Now there's two ways to enter this trade. We can wait for a break of the candle and wait for prices to move through here to then execute the order on a stop order basis, or we can wait for price to retrace slightly, target this gap, and then continue to the downside. Now this is where I like to, or I prefer to place my orders. So what we'd actually do is we'd place an order in the market there at the top or the bottom of the fair value gap. The stop loss will then go slightly 1 or 2 pips just behind the high of the candle there. So we just put it at 1 or 2 pips. 3, 5, there you go, 2, 3, 8, that will do, a couple of pips there. And then what we would do is we would target that daily swing level, which is the daily swing level is down here as marked up on the chart. Now I want this to give at least a 3-to-1 risk to reward. In order to hit the probability game in trading, 3-to-1 or at least a 2-to-1 is normally a good place to be. Now for my strategy to work effectively, I do like to aim for 3-to-1. So I will place an order in the market there at 10 p.m. at night when the daily candle is closed, and then I will shut my charts. I will, well, first, and then I will set alerts in the market at these price levels. So I'd set an alert at the area where I should be tagged into the trade to alert me to the fact that I've been tagged in. I'd set an alert at the stop loss as well at this point. And then I'd leave the charts. I would shut the charts, go to bed, and see what actually happened in the morning. So if we now fast forward a candle at a time, we'll see exactly how this trade played out. So you can see that the price did come down, it did break the bottom, and then eventually at 1 o'clock in the morning, if you just zoom in slightly on this one, this is where we would have been tagged in. I think it did go a little bit higher. There we go. So it definitely tagged in there by 2 o'clock in the morning. Now I came back to the charts at about 5, 6 o'clock in the morning, about normal time for waking up. Even when I'm on a holiday, for some reason, I still can't seem to lie in very much. So let's fast forward to that time. So at 5 in the morning, we see this big shift down, okay? So by the time I actually wake up in the morning, we are already massively in profit. Now, if I shift this risk to reward tool back, at this point when I wake up, we are already nearly 1% up on this trade, which is an awful lot of money, especially when I was trading this across 3 different prop firm accounts and my personal pension account as well. So as we can see, the market tagged in at this level and it then moved down. Now you've got a few different ways of actually handling this trade. You can just set and forget. So this is a good position to be in, and we just see if the market ever comes down and reaches full take profit or eventually comes up here and stops us out. Or you can start to trail stops and take a little bit of risk off the table as the trade progresses. That's what I like to do. mainly because I like to take smaller profits more often. So two ways of actually trailing a stop here. A lot of people, they will trail the stop behind the swing points. So on a trade that's actually aiming to target the downside, they would trail the stop behind these swing high points. So this swing high point here. Other people will sometimes actually trail the stop below thrust candles. And if we actually zoom in on this one here, this one, this long candle here that's left a fair value gap would be classed as a thrust candle. So they put the stop now at the top of this candle, and then they just manage the trade as it comes down. Now you've got to remember, every single one of these candles is representing an hour's worth of price action. So for actual physical management of the trades, you do not have to actually get involved too much, because this can be managed from a mobile phone, worst case a tablet, while you're actually on the move. As long as you've got mobile signal and access to TradingView and access to, say, MT5 to execute your brokers, or IG like I do for my personal account, then you can move stop losses and manage the trade whilst you're living your daily lives. And this is why I like this strategy, especially when I'm actually on holidays. Yes, there are other strategies that I do trade, and I'll talk about these in future YouTube videos where I'll actually trade the London Open and sometimes the New York sessions as well. But I do love this strategy for people that have not a lot of time to actually spend on trading, and they want a more relaxed approach to the charts. So let's actually start going through how we would then trail the stop losses here. So let's just go back and we'll put on a horizontal ray there, and we'll trail the stop losses on the thrust candles. I'll just label this one up slightly differently so you can actually see the differences. So we'll call this a trailed stop. And let's just change the style so it stands out a little bit clearer. There we go. So now we've trailed the stop to this point here. Even if the market does come back up and actually target this area and it goes through here, we would be stopped out for still a profit. All right, a very small profit. However, it would be a profit. And then what we want to do is we want to start looking left and also seeing how price develops through the day. So the next level I would be interested in is this level down here on your screens, because this is the next swing point. So when the price action comes through this swing point, I would then consider moving stop again. So all I'd now do in reality is I would now set an alert at this level as well. So what I'll do is I'll put another ray in there, and what we'll do is we'll label that up slightly differently so you can see what we'd call that. So we call that a move stop alert. So you set an alert on that line, and if the price goes through here, you will get an alert on your mobile phone to say that you need to move the stop again. And I'd also set an alert on the trailed stop line to alert me to the fact that I've now been stopped out of the trade. And if either of these things do not happen, then I don't have to check the trade now for a good couple of hours. So I might just check in at the next point when I feel like it, basically. And this is exactly what I did whilst I was on holiday. So go forward another couple of hours. Okay, so we're now getting to 8, 9 o'clock in the morning. Now that would have alerted me at this point because it did just spike through there. Now I'm only really interested when a trade would actually close below a certain level. So this would alert me to come back to the charts. I'd check, and because it hasn't actually closed below, you can see the close of the candle is up here. I wouldn't move the stop loss just yet. Some people I have seen would now move this stop loss on this thrust candle, so they move it down through here as well. However, I didn't do that. So let's progress a few more candles. This one now closed below this level. So this is where I would now move this trailed stop loss, and I go to my brokers, I will move the trailed stop loss down to here and manage the trade. So if the market now turns around and comes back up here, we are definitely going to be stopped out for quite a healthy profit. And I would then move this move stop loss alert down to the next swing. So as you can see, if we trail back on here, the next swing is down here, which is right above this really big fair value gap. So that's a nice area to target as well. So this is now by 10 o'clock in the morning, 11 o'clock in the morning, got tagged in our sleep at 1 o'clock in the morning. And by 10 o'clock in the morning, we are already, if we were doing this on percentage terms, 2% up on the account. So that's a good 10 grand just across all of the funded accounts, and even different amounts on my personal accounts. So let's just carry on, because I do believe that is where I eventually got stopped out of this trade. there. So the market would have now come back. It's turned around. It's having a pullback, and it would have stopped me out of the trade there for approximately 1% and a bit. So that would have been 1.6% on the account. Now, like I said, if you're even just trading 100 grand funded account, that's $1,600. Okay, there's profit splits that we have to take into account depending on which prop firm you're with, but $1,600 while you have not been monitoring really anything. This entire trade has taken approximately 15 minutes. It takes about 10 minutes to actually set up the trade initially, and then it takes 2 or 3 minutes every time you need to actually manage the stop. So we would have been stopped out there, managed it nicely. That then cleared my entire trip to Morocco. Now let's actually just see what happened if we just left this trade and let it just run its course. So it either stops out or it comes back down. So if we fast forward through here, we'd still, I think, be in this trade now. Oh no, eventually it would have come back up and it would have actually stopped us out of the trade. So, and also I reckon this would have been quite a lot of agony. There are different ways of actually managing this as well. If you do want to exit trades early, you could have exited as you get breaks of structures. So you actually have a change in structure and direction to this side. However, this is why I like to actually just trade the impulse of the initial move. And this is what we did in this situation. And that is pretty much it, guys. The reverse would be the same setup, but for a hammer candle. So we would be targeting a long move instead. But you can see just from the demonstration I've just done then, just how little time effort needs to go into this type of trading strategy. So if you're interested in actually taking your trading to the next level, or want to find out a little bit more about how I find these individual setups, then click the link somewhere around this video, and that will allow you to book a strategy call directly with me, and we can get you up and running and trading exactly how I do in the markets on a daily basis. I hope you've enjoyed this video. Like and subscribe for future video releases. I'll see you on the next one.